the idea of this call is to speak about the transition. And I thought I'd spend a little bit of time to talk to you about how we manage the research process and how we see things changing after Prashant has left. And then we'll have each of the individual FMs talking to you, giving their own background. And I'm sure you're familiar with most of them, but nevertheless, and telling you a little bit in terms of their style and what is their approach going to be to each of the products which have been handed to them. But before we get into that, I think it's important to put in place an overall context. And I think Prashant has done an incredible job here at HDFC at setting up systems and processes, and we are all beneficiaries of that. And having worked with Prashant for more than 15 years, and we've seen a lot of changes take place in this period of time. And the focus for Prashant over the last many years has been on process. And at the end of the day, research is the foundation of what we do. And it is the quality of the people and the quality of the research, which is really the bedrock on which fund management rests. And you really need quality inputs for us to make decisions, because our portfolios at the end of the day are very stock specific and bottom up. We are less macro in our style and much more bottom up in our approach. And hence the role of research is extremely important. And I think the first point to put out there is our research team, which comprises of 9 people in research. Each person has between 15 to 18 years of experience. We have more than 230 years of experience between fund managers and research. I think research itself will be close to 200 years of experience. So we have an incredibly well-rounded and incredibly experienced research team. And that doesn't change, right? So these 9 individuals continue. And I think that gives a lot of continuity to our thinking and approach. So I think that's very important to keep in mind, that research is extremely robust and the team remains the same. We have spent a lot of time in the last 5, 6, 7 years in terms of fine-tuning our research process. And I think it's safe to say that we have one of the most rigorous research processes out there. And I think we should emphasize this when we speak to distributors and to clients. And we've had people who joined us from Goldman, we've had people who've joined us from Morgan Stanley, and so on and so forth. And I think without exception, everybody has been taken aback by the quantum and the effort that we put into research. This is a team which comes in at 8:30 in the morning and leaves 8:30 in the evening. And hard work is not the only thing. We also have to be productive and efficient in how we do things. And just to give you a sense in terms of for each of the companies, the kind of effort that is put in. So as an example, for each of the companies that we research, and we have a coverage of more than 400 companies, for each of the companies that we research, we make sure that we are regularly in touch with them. So what we have is a process where we try and minimize the interaction to not more than a gap of 6 months. So we are in touch with companies typically with a gap of not more than 6 months. We have a process where we meet the founder or the CEO of the company at least once a year. We have a process where we write one detailed base report on each of our companies. We have an annual report review, which is a detailed report on the annual report of each of our respective portfolio and research companies. We meet the entire ecosystem around the company. So that includes suppliers, distributors, wholesalers, customers, private equity investors, and we spend a lot of time on that. We do a detailed peer review of our mutual fund peers to see what they own and don't own, and try and see if we can get ideas from that. We have a very rigorous new ideas program with the sell side, where we provide additional compensation to brokers for ideas provided to us. So there is a lot of, I think, time and effort and process which the research team undergoes. And I think that is the foundation of what we do. So I think we've got an extremely experienced research team. We've got an extremely experienced fund management team. And while Gopal, Rahul, and Roshi will go through it one by one, I think they've all got fantastic track records at the organizations from which they come. And for Roshi and for Gopal, who've already been here for some time, they've had a fantastic track record even here in a relatively short period of time. So I think when you go out to investors, I think the points should be the following. I think the point should be that, listen, the institution is much larger than the individual. Prashant has been here for a long time, and he's put up incredible processes which continue. And we will build on those, and we will continue with the existing process and build new processes in. And therefore, we believe that we will go from strength to strength. I think you have to emphasize the background of the fund managers, their track records, and of course, their styles, which they will respectively talk about. So I think this is the beginning of a new and exciting chapter for us. And I think we've got an incredible team, and I think that's where our focus and attention should be on. And with that, I will hand it over. Maybe Gopal, you can start with. I think Gopal, everybody's more familiar with. He's been in the system a little bit longer. I should just add that I know Roshi now and Gopal for a bit of time, and they're extremely smart, extremely dedicated individuals. So it's really it's a delight to have such a fantastic team. And I think this is one of the things that Prashant was keen that at the time of his departure, he wanted to leave behind an extremely strong organization. And I think that is exactly where we are today. So with that, I will hand it over to Gopal, and then we'll have Rahul and Roshi talk a little bit as well. Thank you.
Thank you, Chirag. So, good afternoon, everyone. So, I have spent exactly 2 years, 1 month with the organization, and I'm managing fund for exactly 2 years. I have completed. So you have seen like large and mid cap fund, Focus 30 initially, then dividend yield fund NFO and multi cap NFO also. So now I have added responsibility of capital builder and now with the balance advantage fund. So as Chirag has really stated well that we have a very strong research process and so which really helps to construct the portfolio very well. And I really admire with the quality of the team we have actually at HDFC. So in terms of as this call is more about the transition and about the new fund, so now the balance advantage fund which I'll be managing. So in general, we have decided to have more systematic asset allocation in this fund as our peer also looks at. So my colleague Srinivas has derived a strategy based on the principle of P multiple and also earning yield, bond yield, and he may discuss it in detail. So he will give me a certain formula and looking at global and local macro variables. So there will be certain percentage of equity allocation will be decided. And on the top of it, the fund manager may get up to 10% leeway to take a call according to the market situation in the portfolio. So currently, whatever portfolio has been given, really it is a top class portfolio and which has really tested over years and which has done remarkably well. And as a normal portfolio, everything changes over time. So and it's always a dynamic condition. So what I would say as my style is also like a guard. So essence of the portfolio will remain the same. So, and we will take judicious decision over a period of time. So I stop here.
I just want to briefly summarize what Gopal has mentioned, and then we'll hand it over to Roshi. So I think there are two parts when we look at BAF, right? So I think BAF has gone into incredibly strong hands with Gopal. Now we've had a more ad hoc approach to asset allocation in the past, and I think the need of the market and the desire of the market was to have a more structured approach to asset allocation, which means there is a little bit more clarity and a little bit more a formula-based type approach. It doesn't mean that the formula approach will constrain us. It just means it will guide us, and we will have some flexibility around that. But I think the key is, as opposed to having ad hoc, it needs to be a little bit more systemic in terms of our approach. So I think that's the first part which will change, which is what Gopal referred to, is that asset allocation will be looked at in that fashion. So there's a I think there's a refinement of that process. It's not a change as much as it is a refinement. So I think that's an important communication to bring to investors that, we are now looking at asset allocation in a systematic fashion. We have a certain approach, and that approach will be enunciated by Srinivasan in terms of looking at various valuation parameters, macro variables, and then we'll have some flexibility around it. So I think that's the first part. And as Gopal pointed out, the fund has got a strong track record, and Gopal's orientation is not to change it in a rapid fashion in the near term. Right. So I think changes in that sense will be gradual. So I think that's an important point to bring across. And I'll add a third point, which Gopal has at least mentioned to me, which I think is important, is he has a very, very strong focus on risk. And I've seen that in the existing funds that he runs as well. So he's very keen not only to maximize upside, but also to look at more steady and predictable performance. And I think that is something which is investors look forward to. And I think that's something which is a strength of his. So in that sense, I think you will see tight risk management from him. So with that, I'll hand it over to Roshi. Thank you.
Chirag, just a minute. Before we call Roshi, can I have Srinivasan, because that's linked to BAF. So let him complete BAF part first.
So yeah, thanks, Ashok. So yeah, broadly, I think I'll just maybe quickly highlight some broad contours and this is obviously subject to some refinements, and we will try and look to send out a more detailed framework on this shortly. But the way that we envisage it, I think there would be points of similarity between the way we run the existing frameworks for our asset allocator and multi-asset, and there would be some points of divergence also. So I will just like to kind of quickly highlight both of these aspects. So from a similarity standpoint, if you look at it, I think valuations will continue to be a cornerstone for evaluating the right level of allocation between equity and debt. The valuation model that we use might see some updates and some refinements, which I will probably detail out, and happy to do that later as well. But that will remain a cornerstone. But in addition to the valuation model that we use, I think what we would also look to do is to bring in an element of macro overlay, and that will try and add some medium-term perspective to the framework, because it will, and will also reduce the price-related volatility that we see in some of these frameworks. And the thought process here is fairly simple. That is that what we want to do is we would want to evaluate the macro backdrop that we are currently in, and try and ascertain what macro regime we are in, because typically, whether you look at debt or you look at equity, I mean, as an asset class, they tend to have headwinds and tailwinds to performance depending on the environment that we are currently in. And here, obviously, both domestic and global factors would need to be considered to determine what macro regime that we are currently present in. And basis, and this is one area of change between what we do in, like I said, in asset allocator multi-asset versus what we would look to do or strive to do in BAF. And the and basis this, what we would do is that we would suggest a range, as I think Gopal mentioned in his earlier comments as well. Here we would want to look at a range and provide this range to the fund managers, individual fund managers, both on the equity and debt side, and they can choose based on bottom-up opportunities that are available to them on where they want to be within that range. And I think here it would be also important to, I mean, this is also a point of divergence between multi-asset and asset allocator versus this, because in both of those products, what we do is typically we have a point number and we try and kind of work with that point number or stick close to the point number as much as possible. But here we want to give in a range. And while we might, from a top-down standpoint, want to give some bias to within the range to the fund manager, but it would ultimately it would be, I think, left up to the fund managers in terms of where they want to be within that range. So these are the broad thoughts, I think, which I wanted to share, and obviously I'm happy to kind of address any follow-ups that you may have. But yeah, with that, I think I would pass it on to the to Roshi maybe. Yeah, thanks for that.
Yeah, thanks, Rini. Yeah, Roshi.
Hi. Hi, this is Roshi, and I've addressed the team a couple of times, so I presume that there is some level of familiarity with me. I've been here for about 6 months now. I've managed the tax saver product here and the focused equity product. In terms of investment style, I think there is. I see at least a terrific congruence in investment style, because it is about growth, but looking for growth without losing sight of valuations. And therefore, I see, continuity in terms of the style that was followed as far as the flexi cap was concerned. I just like to reiterate again just some key points in terms of the investment philosophy. I think two broad aspects to the philosophy. One is, of course, focusing on good quality companies, and I think there the research process that is set out does an extremely good job of helping identify medium and long-term drivers for companies, competitive positioning within an industry. And therefore, to that extent, the research-oriented part of identifying companies remains the same. The research team is the same, and therefore we all use that as major input for arriving at or for selecting good quality companies. The second parameter, which focuses on valuations, and I think that's where perhaps there is a little bit, there could be a little bit of difference of opinion as to what counts as cheap and what doesn't. And I think there maybe the slight difference in approach is just a more holistic way of looking at valuations. I think, and this is also part of the research process where different sector analysts use different ways of evaluating or valuing companies. It doesn't necessarily have to be the cheapest in terms of price to earnings or in terms of price to book. And I think that holistic approach to valuations is perhaps also one of the key tenets of portfolio construction as well as stock selection. To my mind, the tax saver product is perhaps a good reflection of the investment philosophy as well as the investment approach that I have followed in portfolio construction, and that should give a good reference point to our internal team as well as to the external people, external stakeholders in terms of the investment style and philosophy. One of the common themes of my career, where I worked before joining HDFC, has just been the focus on a research-oriented portfolio construction methodology, and I think that that continuity here. So I lever off that and put that in practice here as well, and lever off the very strong research team that we have here. So both from a research perspective as well as a portfolio construction perspective, which focuses on good fundamentals and at reasonable valuations, I think there is significant congruence in style, and therefore I would not expect any significant changes to the portfolio. Changes, if any, will be incremental, and I can assure you will happen in an extremely non-disruptive manner. Given the significant tailwinds that the product has, FlexiCap is is doing extremely well, and many of the bets are now showing extremely healthy operating performance as well. So really there is no significant or there is no material reason for me to be making significant changes in the portfolio, and given the congruence and style, I think there is also no reason to be doing so. I will stop with that and will pass it on to Rahul.
Thank you very much for this opportunity. So clearly, I'm the new face in the team, so I'll spend some more time giving some flavor on the background. So I joined 4 weeks back, and just to give a flavor, I've been in the industry for about 2 decades. Initial years was spent doing equity research, and for the last 17 years, I've been managing funds at different companies. I've had a track record across hedge fund management for about 7 years, life insurance for about 4 years. And my last stint was with Sundaram Mutual, where I was focusing on the large cap oriented products, where I spent the last 6 years. At Sundaram Mutual, basically, I was looking at the large cap fund, the equity hybrid fund, and some thematic schemes like the services fund, and also managed the large and mid cap fund for some time as well. In terms of the focus, my focus has been mainly large cap oriented products over the last 2 stints. As I travel more in the coming months, I'll clearly meet a lot more of you, and then we'll get to know each other better. So I'm looking forward to that. Now going into the product, clearly, I think we've sent a product note, which would have reached most of you. In that, I've tried to summarize some of the key questions which may arise in your mind uh, in terms of investment philosophy, in terms of what changes may happen in the fund in the short term, in terms of the investing style of the product. So I'll quickly run through some of those thoughts which are already there in the product note, and happy to take follow-ups if any. So broadly on the investment philosophy, clearly there is a match in terms of what I've been doing in the past and what is being done in this product. The investment style is also focusing on building portfolios from a medium to long term perspective, and stock picking is done with the help of a very robust process. So the width and the depth of the research inputs are clearly outstanding. And as I interact more in the coming weeks, gradual realignments will happen to the portfolio if required. Overall, on valuations, clearly the philosophy is very much valuation mindful, which is again core to the philosophy here. And the plan is always to stick to the investment mandate of the product, and follow a proper risk management framework which is designed as per the mandate. In terms of the fund specifically, on top 100, the portfolio construction will continue to follow the style, bottom-up style, blended with top-down sector and macro trends. And it's going to be a blend style because the benchmark has both GARP and growth and value stocks. So it's going to be a blended style. And in terms of stock selection, the focus will be very much on picking up good quality companies. And when I say quality, quality in terms of the quality of management, business models, and also financial metrics and the trajectory going forward. Risk management, like I mentioned, every mandate, every product needs to have risk management, which is customized. So this product also, like it has been in the past, will continue to take active positions, but in a controlled manner. And deviations, whatever they are in terms of sectors, deviations of the benchmark, will be on a measured basis. In terms of changes in the portfolio, I think broadly sector positioning is something which we have highlighted in the product note. In fact, just to give a background, a few months back when I left the large cap fund, the sector positioning is very much similar. So I don't expect much changes on that front in the short term. And going forward, as you know, as active fund managers, as and when opportunities emerge, as and when macro changes, as and when companies realign their business paths, some active changes will be done slowly and gradually based on the inputs coming from the excellent analyst team we have over here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.